Thank you, Andrew, and good morning, everybody. It's a pleasure to be speaking to you all once again in our latest webinar on the impact of COVID-19 on the macroeconomy and the credit markets. It seems like a different world when we first started these webinars and we were talking through the likely impacts of COVID-19, and you heard me band around forecasts about it being the deepest recession on record and record number of job losses that we were going to see. On the slide that you're seeing now, we've seen some growth. We've seen some growth for the first time in 4 months since the start of March coming through. And what you're seeing now in the latest numbers for May is the economy did tick up slightly. You can see there, right at the bottom of that line of the April and March negative numbers, the economy did start to grow in May. Now, that was in line with expectations. In fact, we were expecting a slightly sharper bounce back. However, what you can see there is a 1.8% bounce back month on month. Now, what does that mean? Well, 2 things. Firstly, the recession is over. So the technical recession that we're seeing will come to an end in Q3, as we were forecasting ahead of our webinars in March. So what we have seen is the 2 monthly growth numbers in January, February, followed by a very deep cut month in March. So we saw growth fall back by over 2.1%. The whole quarter, therefore, fell by 2%. And so as we moved into the next quarter, which is going to be dominated by that fall of 20% in April, you therefore get 2 negative quarters, one of around 2 and a bit percent, and the other with what's going to end up being around 19% in terms of overall growth. And where you end up, therefore, is looking through a story which is showing you, as on this slide here, we're seeing an economy that's shrunk by 20%. Now, why I say we've returned to growth is because once we came out of lockdown and we've seen non-essential retail open up, and we've seen other lockdown measures ease, the easing of restaurants and pubs, and obviously the very recent launch of the Eat Out incentive by the Chancellor, we are going to see growth returning, and we are going to see the economy starting to open back up, and therefore those record months of falls in the economy are going to turn into relatively modest but growth nonetheless. And the idea here, therefore, is actually we are still seeing the impacts of the recession. We're going to see the impacts of the recession come through for at least the next couple of years. However, the technical element of it, what economists call out, we are expecting that to be a Q1, Q2 recession. And as we moved into Q3, in fact, where we are now, and when the data catches up, it will show you that the economy has exited recession, albeit at very, very considerably lower levels than what we had pre-COVID. So let's move on to the next slide. That's what GDP is saying. Some good news, I guess, or shall we say a point of reflection. I'm hoping a point of discussion for all of you on the webinar today. Retail sales, so spending on going out, spending on food, tobacco, spending on takeaways, also included in this spending at department stores, online sales, etc. The overall retail sales picture is one of the few indicators that is pointing and has pointed to a V-shaped recovery. You can see very clearly there that taking the last 2 months of data, so looking at June and May together, we are actually seeing that retail sales have bounced back to near enough pre-COVID levels. Now, I bring this chart up because it matches really well to some of the insights that Dave and in even previous webinars, Andy, have taken us through in terms of the retail market for credit. That boom in retail lending that we saw coming through our Keys Bureau data has translated into this V-shaped recovery in retail sales at the very least. Now, the question that I would pose to all of you, and I'll answer it myself in terms of our view as at Experian, is this going to be a short-lived recovery? Are we actually going to see a stronger bounce back in overall GDP and retail sales than we're actually expecting? Or is this very much just a one-off pent-up demand story that once actually people start to see the true impacts of unemployment come through, the true impacts of the income shock, again, Dave will take us through later, that actually what we're going to see is this line, this index actually bounce towards the right-hand side and move very slowly. So our view is that we're in a delayed V-shape, and because we're in a delayed V-shape, actually we've seen a strong bounce back, but that is going to now be succeeded by a slower economy in terms of growth. Let's move on to the next slide. And again, I just wanted to introduce to you some other key variables that we have now started tracking. Footfall on the high street, and again, footfall is around 60% of where it was pre-COVID-19. And again, as you can start to see here, and we'll continue to watch this indicator, the real-time indicator for the economy, it's starting to move more sideways than actually up. And again, that feeds into our narrative that things are slowing down. I'm going to spend some time today on unemployment. I want to try and unpick what unemployment really means for all of us as credit market practitioners. For those of you who've attended these webinars before and who've actually talked to us in other face-to-face webinars, if we move on to the next slide, please, Toby, you would have heard me talk about the relative usefulness of unemployment actually diminishing, and unemployment as an indicator for credit losses over the last few years, given the rise of the gig economy, the rise of fixed-term contracts, part-time work, etc., actually seeing less of a correlation with overall losses than it once did. Now, that's very evident. I've spoken to you about the deepest recession on record. I've spoken to you about the fact that GDP has only slightly bounced back, and yet all of that volatility doesn't come through at all in the official unemployment numbers. What you're seeing there is unemployment bouncing around 4%, not really moving anywhere. And therefore, whilst we all know that furlough is happening, we know that there's an income shock happening, we know that, again, as Dave is going to take us through, we are seeing delinquencies starting to come through. Why is none of that captured in unemployment? And so I'm just going to move us on to the next slide, take a step back, explain why unemployment is important to us as credit market practitioners, talk about some of the shortcomings in the near term, and then talk about the work that we've been doing to try and overcome this slightly, should we say, misaligned link between unemployment and the credit market. So first and foremost, unemployment is an economic variable. It's an economic variable that matters a lot for governments. It matters a lot for international comparison purposes. And therefore, the ONS have adopted what is known as the International Labour Organization's view of unemployment. Simply put, to be classed as unemployed, an individual has to have lost their job, has to be actively looking for a job, and be able to restart work within 2 weeks. Now, even in normal times, those constraints can sometimes lead to people who are actually suffered a job loss not being counted in those numbers. COVID-19 has really, should we say, brought light onto this matter, even more focus on this matter, and is leading to a further deepening of the difference between job losses and unemployed. Simply put, somebody working in a sandwich bar in a train station for the last 12 years have lost their job, and now they've lost their job, there's a hit to income, but they feel now is not the right time to look for work. They are disengaged from the labor market. They are no longer looking actively for a job. Now, they will not be counted in those unemployment numbers, yet from a credit market perspective, all of us as credit market practitioners, they are the same people that are likely to see a rise in their inability to actually keep up with credit commitments. They've suffered a job loss. They are going to suffer an income loss, and therefore they are more likely to actually no longer keep up with their credit commitments and actually have a failure to pay. Now, that individual is not captured in unemployment. They are captured in other figures, which we will show you now. So it's important to look for the detail underneath that headline number. So as we move on to the next slide, we are estimating that the real unemployment rate isn't below 4%, it's at least 6%. So almost what we are truly measuring here is the largest annual decrease in total hours worked on record since that became a statistic. And we can also see that the number of employees has also started and continues to fall. So the difference between those two unemployment numbers is over 500,000 people. So there are 500,000 people at least that are not being captured as unemployed, but we feel have lost their jobs. And so from a credit market perspective, when you're trying to run through the economics and economic impacts for your businesses, you really want to try and use numbers which are more aligned with and better correlated with the credit markets rather than an official definition of unemployment. As we move on to the next slide, it just helps me to actually point through the fact that at the very worst, we could be seeing a misalignment of around 1.5 million people. So there could be 1.5 million people extra who've actually lost their jobs than what the ONS is suggesting in their latest unemployment numbers. Now, that's a combination of people who are no longer actively looking for it, yet they've lost their jobs. And so, again, will struggle to repay credit, but they're not captured in the unemployment number. And it also contains people who are actually declaring themselves as temporarily unemployed. The COVID-19 pandemic has led to the ONS having to come up with different and new survey questions, and some of those questions are aligned around whether people feel they're temporarily unemployed. Now, people who are saying they're temporarily unemployed are not in the furlough scheme, so they have no recourse to actually any type of income from the furlough scheme. They are not actively looking for a job, yet they've basically lost their job, and they feel that they will go back into some kind of work once the pandemic is over. In that intervening period, they're not classed as unemployed, yet they are going to be seeing a hit to income. Again, our bureau data is showing that big parts of the UK population are seeing hits to income due to COVID-19. On this slide, therefore, there are a different range of unemployment forecasts, and we believe that the most likely outcome is still that unemployment will reach above 9% in terms of the unemployment rate that is most relevant for the credit market. The official number, according to our estimates, could actually just about peak above 7%, and the peak will be much later than what we are seeing as the impact for the credit market. So we are helping our clients to actually run through these more tailored unemployment curves, these more bespoke unemployment curves, to actually capture the true risk to portfolios on a lender-by-lender basis, rather than once again using a UK average, which it's showing that it's incomplete in its way that it captures the impact on the credit market. Unemployment just isn't moving as quickly as you would expect. Next slide, please, Toby. So the other thing I would mention, like I have done on previous webinars and previous interactions, we need to make sure that we're not just relying on unemployment. We need to look for other variables within the economy that we can tie to our delinquencies, that we can tie to our loss provision forecast, and they will take us through the income shock variables and what we're seeing there. But again, that's down to an individual level. That's an amazing piece of data insight which can help you actually understand, move away from just macroeconomic variables such as unemployment down to an individual level. Have they suffered an income shock? Yes or no? Are they therefore more likely to actually become delinquent? Again, something that we will touch upon later on. The next slide, please, Toby. Even from a macroeconomic perspective, income and the income shock is starting to take a hold. And as that income shock takes hold, we are going to see a deterioration again in the ability of people to any of their credit commitments. Again, like I mentioned before, income is a very good indicator of overall credit delinquencies. Normally, when we see unemployment, what we're really concerned about is when somebody loses their job, is that it's going to impact their ability to repay their debt because they are going to lose that income. If people are almost losing their job, not showing up in the unemployment numbers, then you do have to look for other ways of capturing that income shock. And you can do that at the macroeconomic level using average pay. You can do that at the individual level using some of the bureau data as well. My next set of slides is going to return to the furlough data that we showed last time. We've done some further analysis on this, and it's just to bring home the fact that we are seeing different variations in terms of where the furlough schemes are, and therefore as the furlough schemes start to change, and we've seen in the first month of that this month as employers have started making national insurance contributions, and as we move towards the cut-off date in October, these areas in the country who have a higher reliance on furlough are more likely to see an increase in unemployment, or shall we start calling it an increase in job losses, than other parts of the country. And what we've done here, once again, is rank them in absolute terms, but again, in relative terms, you start to see those big aviation hubs such as Hounslow and Crawley, so Gatwick and Heathrow, respectively, showing that they are going to be harder hit than other local areas. The next slide is then just going to run through a scenario whereby we see 10% of the furloughed population who actually enter unemployment and therefore do not return to their jobs. And again, all of this data is available at a very granular local area level, so you can map this directly back to your portfolio. You can see how concentrated your lending is in any of these areas, and therefore are you going to be seeing a higher risk of unemployment, job losses than your peers? Have you provisioned enough? Actually, are you more robust, more resilient? And I'll get onto that in a moment. The next slide is introducing the furlough tool. So what we've gone away and developed is a tool where you can actually plug in your own assumptions around local area, but also sectors. So you can just look at maybe a 30% hit to the jobs in furlough currently in the retail sector. So 30% of people on furlough in the retail sector do not return post-October. What will the impact be? Which parts of the country are going to be hardest hit? And we're making that tool, we're going to be hosting that tool on our website soon. So all of you will have access to that, and you should be able to go away and run your own scenarios. If you're interested in getting access to that sooner rather than later, please do get in touch with your account directors, and we can send over a spreadsheet version if necessary. As we move through to the regional economics for today's webinar, I'm going to take in turn the unemployment rates over the next couple of years. So as you can see here, in 2019, we expect the Southwest and the East Midlands to continue to do well in terms of unemployment rates from last year. But as we move into this year and we go into 2020 and 2021, you'll start to see there's a shift in the pattern. There's a shift in the pattern in terms of which parts of the country are going to see the biggest increase in job losses. And you can see one thing that I will call out is that the Southwest has gone from being one of the best performers in terms of unemployment to the worst performer in unemployment in 2021. So by next year, we've seen a reordering of the economic norm. And the Southwest, given its sectoral mix, given the demographics within the Southwest, we are expecting unemployment to disproportionately hit that part of the country. However, as we move into the recovery stage and you go into 2022, you do see somewhat of a rebalancing towards what has been the economic norm over the last 5 years, with the Northeast once again seeing a slower recovery than the Southwest, and therefore becoming the absolute leader in terms of unemployment. So what we're calling out in our latest regional view is somewhat of a reordering in the near term, with the Southwest being hit the hardest given the sectoral mix and the demographic mix. But as we move further out into our forecast beyond the next couple of years, you do start to see a stronger recovery in the Southwest, and the Northeast starts to struggle a bit more in terms of a comparative advantage. Next slide, please, Toby. And this is just going to show you again that we are able to forecast through at a granular level gross value added, so that's GDP growth. I guess we've taken this out of a 20-year period because we do just want to show the very long run. And it seems from our forecast that even once we move past the impact of COVID, longer term growth will actually settle back into the familiar role that we've seen in terms of the greater Southeast, London and the Southwest actually leading the growth. And a lot of that is to do with the demographics and the aging population. And so what we are seeing is as you move past looking at the very near term towards some of the longer term, some of our credit products are actually more aligned to that longer term view. You are seeing the economy settles back into its regular stance of the Southeast and London actually leading the pack. Next slide, please, Toby. So we're just going to bring up a few other key pointers in how we're seeing the economy and the impact on consumers, especially, unfold. So what we are seeing is, again, in keeping with what we've been calling out from our FSS analysis over the last couple of months, all of our income analysis over the last couple of months in terms of the economics view, that the lowest quintile, so the bottom 20% in terms of earnings, those people have seen the hardest hit according to the latest economics data. So what we are seeing is that there is almost a 15% hit in terms of wages and salaries between January and May 2020 for that group. Now, what I want to bring up on the next slide, however, is when you take into account benefits, welfare benefits, then that section of the economy has actually done slightly better than the others. And the way to explain this is they had recourse to welfare benefits, universal credit, even before COVID-19. During COVID-19, welfare benefits and universal credit have become more generous, and therefore, for that bottom quintile, what you're seeing is a very low, I would even call it just a flattening of incomes, but basically they have done the best in terms of overall income. So not just looking at wages and salaries, but actually looking at the wider set of numbers that feed into incomes, so benefits and other such things, that group's actually been better protected. And that's important because that allows you to then do some further analysis on your own income and distribution, but also on your own credit portfolios, because you're able to then link these quintiles back to FSS groups and actually start to understand that maybe some of those younger groups, but slightly more affluent than just the lowest affluent groups, may have also seen the hardest hit in income. Next slide, please, Toby. What we're seeing on this slide is, again, the ability to keep up with credit payments, and emergency payment holiday, something that Dave will go into in greater detail, seems to be clouding the picture on the ability of non-payments for mortgage bills. So we can't really read too much into that because emergency payment holiday seems to cloud the picture even for this data set. But what we can see, again, in keeping with the previous couple of slides, is that the second quintile, so those not in the lowest 20%, but actually between the 20 and 40% in terms of income, they are the ones who have seen the greatest hit to incomes and are actually struggling to repay utility bills and council tax. So once again, just showing the correlation with what we're all interested in as credit market practitioners. Unemployment's always been a good indicator, but what we need to do is dig beneath the detail. We need to understand that income is a great driver of ability to repay debt. In the past, unemployment was very well correlated with income. We are seeing a difference here. In the stats that Dave will show us, you'll see that incomes are being hit, yet the unemployment number at the macroeconomic level has not been. So that is breaking down. The next set of slides that I have before I hand over to Dave is really about trying to move the story on. We're still in the midst of an economic crisis, most definitely. The economy is recovering, but recovering slowly. There's going to be a huge debt burden for firms who have borrowed through various different government schemes, and they're going to have to make sure that they remain profitable. Consumers are still going to be very nervous about an increase in unemployment rates. They're still going to be trying to understand whether or not they should go out and spend. And again, if we see another rise in infection rates, then we could see another lockdown. So most definitely we aren't out of the woods in terms of the economic crisis. But what we can do and what we started to do at Experian is starting to actually look for areas of the economy that are performing better than the average, and actually in our forecast across all different types of scenarios continue to be relatively robust. And what we've termed here as a confidence index, we're able to start to talk to you in terms of which parts of the economy that we're most confident in terms of a local area, are going to be most robust to the next couple of years in our economic outlook. So what you're looking on this slide is the different ingredients that we've put into this index, and there shows everything from sector composition to furlough take-up and house price growth. So let's move on to the results briefly and show you once again what we're thinking in terms of which parts of the country see the highest score in this index and which parts see the lowest score. Again, I've spoken at great depth about the Southwest, and you're starting to see that come through in our confidence results as well, that they continues to trend behind the rest of the country. But again, when you get down to that very granular level in terms of those local areas, the idea here is to show you that there are parts of the country that remain quite resilient, quite robust. If we're looking to continue to lend throughout the crisis, actually taking this confidence index into account will start to give you another data point to run through your models, to run through and understand how the economy is actually going to be impacting you and the credit markets, and actually help you say yes more in terms of lending decisions. And my final slide there, it just shows you once again the overall confidence index and the constituent parts that make that up. That's been a rattle through in terms of the economics. We are hosting a much more in-depth session on the 11th. If any of you are interested, please do sign up to that, where we'll be able to go through the trends at a slightly slower pace. But with that, I'll hand over to Dave, who will take us through today's credit trends.